Okay, continuing on with problem 8-4A on page 397. We completed instruction 1, calculating the due dates and interest due at maturity for each of the 6 notes in the first 2 videos. You can omit instruction 2 and you will not have one like that on the final. So moving along to instruction 3, journalize the adjusting entry to record the accrued interest on notes 5 and 6 on December 31st. Okay, let's talk about that for a moment. If you remember back to chapters 3 and 4, we make adjusting entries at the end of the fiscal year. In this business, their fiscal year is the calendar year, so their year-end date is December 31st. We make those adjusting entries at the end of the year to bring the accounts in the ledger up to date. Well, here's the deal with notes 5 and 6. Remember, we mentioned earlier that they began in one fiscal year and carried over to another. So note 5, for instance, we earned 1 day of interest on note 5 in November, 31 days of interest on note 5 in December. So in the first year, we earned 32 days of interest on note 5. The other 28 days of interest on note 5 were earned in the next fiscal year, or I'll call it year 2. With note 6, we earned 1 day of interest on note 6 in the first year, the other 29 days of interest on note 6 in year 2. So you guys, if we've earned part of the interest in the first year, then we want that interest earned to show up as interest revenue on the year 1 financial statements. It would be interest revenue would show up on the income statement, as you're aware, with all the other revenues and expenses. Now, we haven't been paid that interest yet. We will receive it at some point in the future. And this was one of our other receivables we mentioned in the lecture video, interest receivable. Actually, I'm not sure that I mentioned it there, but it would fall into that category. That just means interest that we've earned that we're going to be paid in the future. So what we need to do is calculate how much interest was earned in year 1 on note 5 and how much interest was earned in year 1 on note 6. So I'm going to call these accrued interest calculations. And accrued just means built up. Okay, so let's start with note 5. Now, your formula is the same as earlier, you guys. It's going to be equal to note 5, the face amount was $27,000, times our interest rate on note 5 was 6%, times the number of, here's where it's a little bit different, times the number of days in times the number of days of interest earned in year 1 for note 5. Well, we had 1 day in November, 31 in December, so it's going to be times 32 days divided by 360 in the year. So that gives us interest earned on note 5 in year 1, or interest earned on note 5 by December 31st, year 1, is $144. Now let's look back up. Total interest on note 5 was $270. Interest earned in year 1 was $144. So interest earned in year 2 would be $270 minus the $144, which comes to, what is that, $126, right? But this is the only number we need for now. So let's talk about how we did that one more time. We said $27,000, the face amount on note 5, times 6%, the interest rate on note 5. But this time, instead of picking up the full term of 60 days, we only picked up 32 days. The 1 day from November and the 31 in December. That's the number of days of interest earned in year 1 on note 5. Okay, let's do the same thing for note 6. Okay, note 6, the face amount is $72,000 times the interest rate on note 6 is 5%. times how many days of interest were earned on note 6 in year 1. Well, look, only 1 day, right? Times 1 divided by 360 gets us $10 of interest. Seems kind of like a lot to me. I guess it's not. It's a low rate, 5%. The reason that number is big, $10 for 1 day, is because the face amount of the loan's large, $72,000. Okay, so let's add those two together. So that gives us $154 accrued interest on notes 5 and 6 at December 31. See what that did up here. Oh, nothing. Okay, so 154 is the amount of interest earned on notes 5 and 6 by December 31st. Okay, you guys, we have to make an adjusting journal entry for that $154 to update the interest revenue and interest receivable accounts on the books. If we don't make that entry, then interest revenue and thus total revenues on the income statement would be understated or short $154. Also on the balance sheet, current assets, specifically interest receivable, would be understated or short by 154, causing total assets to be short 154. So we don't want to leave off revenues and assets on the financial statements. So let's look at the entry we'll make. If you notice at the bottom of the page you have different tabs for different instructions on the problem. So if you switch over to the next tab, you've got a journal page. We're going to make the entry for $154. Adjusting entries, remember, are always dated the last day of the fiscal year, in this case December 31st. And we'll debit the asset account interest receivable to increase its balance by 154. Oh, sorry. I apologize, you guys. I had my email open and it timed out and popped up there. So we're going to debit interest receivable for $154 to increase its balance. So it increases the balance of the asset account. Remember, assets increase on the debit side. And we're going to credit our revenue account interest revenue for $154, which increases its balance. That way, interest revenue and total assets on the balance sheet will be correct when we prepare our financial statements, and interest revenue and total revenues would be correct on the income statement when we prepare it. Okay. Instruction 4, that takes care of instruction 3. And there all we did was calculate the amount of interest earned by the end of the year on notes 5 and 6, and we made our journal entry for that amount. Okay, next on instruction 4, you guys, why don't we just do that in the next video? Okay, so we'll wrap up the problem with the next video. Thanks.